Our next speaker, the last but certainly not the least, is Professor S.M. Professor Yu is truly a fintech expert, if I may say. For those who have attended the last module, you must remember the sharing by Dr. Chow on cryptography. Actually, Professor Yu and Dr. Chow, they are colleagues with the Department of Computer Science at Hong Kong U. Professor Yu is a professor with the Department of Computer Science of the University of Hong Kong. He is also the Deputy Director of the HKU SCF FinTech Academy of the HKU. Professor Yu is an award-winning researcher and teacher in the area of computer science. He will talk about the basic mechanism of algo trading, why algo trading has become popular, as well as algo trading strategies. He will also introduce the generic framework of machine learning for quantitative trading and what kind of professionals are needed in this field. Professor Yu, the stage is yours.
Thank you very much. First of all, I would like to thank the organizer of the Hong Kong Academy of Finance for inviting me here. Okay, and also thank for the members and the friends to stay behind and listen to my talk. I hope that after two very insightful talks by Professor Anna and also Irene, you are still not too tired to listen to my talk. In fact, before I start my talk, let me share my view on Irene's talk. In fact, I agree with her a lot. You know, after knowing that she also tried to learn and know Python. Okay, I'm very happy because you know you can see algo is everywhere as she mentioned about it. So that's why today I want to talk about another application for algo in finance called algo trading. And of course, it's also related to AI. So basically, this is what I want to focus today. Now, I want to talk a lot of things, but then I know I only have 30 minutes. And so what I'm going to do is I will try to give you a very brief introduction to this topic. And if you know, audience are interested, then probably we can arrange another talk, another seminar with the Academy of Finance later, right? Okay. Now, also here is my agenda. I will try to give you a very, very brief description on algo trading, and then I will quickly go into one particular area of algo trading, which is called quantitative trading, and I will let you see how AI can help in this quantitative trading, and I will try to give you a generic framework and let you understand what are the difficulties that if we want to apply AI in this area. Now, my talk actually has two aims. The first aim is to let you understand, you know, what kind of skill set we would need to have in order to apply AI in quantitative trading. And on the other hand, I also want you to take a look at it if you haven't. In fact, this is actually a booming area. Then I will conclude my talk. Okay, now probably you heard about this term or come across these terms a lot, algo trading, of course, right? But then you may also heard about electronic trading, high frequency trading, automatic trading, black box trading, robot trading, etc. Now let me just focus more on the electronic trading and algo trading first. Okay, now electronic trading basically has been around for a very, very long time, because when people talk about this electronic trading, is compared to the manual trading that we are using phone, fax, human broker to do the transactions. Okay, so basically, if we are doing the orders via network, computer system, or even apps, then it is already qualified as electronic trading. Now then, how about algo trading? Now there are many, many definitions if you look in the internet, but roughly speaking, you can think about it this way. We try to make use of computer algo and also programs to determine the trading strategy, order execution, etc. Then we will say that, oh, we are using algo trading to do it. Now, of course, under algo trading, we can also subclassify the algo into different classes. Okay, one particular class which is like I know a lot of people are very interested in it, is the high-frequency trading. But unfortunately, actually it requires a lot of more time to explain this high-frequency trading. So that's why I leave it to next time, okay? So don't be upset about it. And after my talk, you will realize that we might not have enough talents and professional in this area. So that's why I encourage audience to try to take a look and then learn a little bit more on this aspect. Now I give you a figure to look at it. Now this is the U.S. market. Okay, like if you look at it, the electronic trading, the blue line, basically start from year 2000 is already like 20-something% in U.S. So meaning that they are actually transforming the paper, human, manual, all the doing the all the transaction to computer systems, networks. Okay, but then on the other hand, you can see the algo trading actually start to pick up around like 2006, and then up to now. The statistics is about up to 2019. Then you can see that it's about 80-something%. The trading is using the algo trading. Okay. Now, in fact, the study is similar to other statistics other people study. Okay. For example, in another report, you can see that they also talk about in U.S. or the developed finance markets. There's about like 70-80% overall trading volume is actually from algo trading. But on the other hand, in some other like emerging economics, like Indian, the overall percentage is about 40%. Now, I actually hear it seems like they also include high-frequency trading. Now, if you single out the high-frequency trading out, the percentage is lower for high-frequency trading. And so you can also think about it, whether we have more opportunities there, okay? So I leave it to you and then see whether you want to, get into this area. All right, now, because time is limited, so what I'm going to do is I quickly get into one of the examples that we are using algo trading a lot in the industry, which is called the quantitative trading. Now, let me just give you some characteristic of quantitative trading. Usually it involves transactions of hundreds of shares or securities. And it also relies on the analysis of historical data or computer programming or computer algorithms or some mathematical models. Now, if you are in this area, you know that these few years we are changing the style of doing this quantitative trading. But before, the existing problems are we usually rely on manual strategy development. Then you can see that it's either time consuming and the efficiency is low. And sometimes you have to repeat the same kind of analysis from time to time. And more importantly, it's very difficult to get a good trading team. And usually you need to give them a lot of bonus, okay? And this analysis and trading team is very difficult to keep. So in other words, it's also difficult to maintain high quality staff. Now also, as the complexity of the current market increase, it seems like now it's not easy for the investment professional to capture and model the situation right now. Now, so in these few years, we actually asked us a very good question. Can we automate the process to generate investment strategies? And then, because we want to automate the process, then a natural question is, can AI help to generate effective strategies? Now, I assume that you also attend, Professor S.M.'s talk in the first module. Actually, he also gave some example on how AI can be applied to different area of fintech. So right now, I want to focus a little bit more on how AI can be applied to this quantitative trading. All right, now, let me give you some more statistics first, so that you have more confidence that AI is useful. Okay. Now, according to a report from a fund research institute, they based on like 7 years of data. they find that the return and also the Sharpe ratio, they try to compare the traditional quantitative industry and also the AI trading fund. It seems like the return of the AI trading fund is about 3 times. And also the Sharpe ratio as well is 3 times higher than the traditional quantitative companies, okay? And they also look at the past recent 11 Black Swan events, and they find that if you are using AI trading fund, we still do have some losses, but it's like small losses, only 3 small losses, less than 1%. But on the other hand, if you are using traditional strategy, then there were like 7 losses, and 4 of them are actually bigger than 1%. Now, from this kind of statistics and what I talked about, then it seems like AI is quite promising in this area. Now, then how AI can work, can help? Okay, now let me give you a very generic framework first. Now, if you look at my slide here, I think it's very standard for people using AI to do something. Okay, now you can see that first of all, we require data, some kind of input data. Now, in our particular example, then you can see on the left-hand side, we are talking about the historical data. For example, stock prices, 5 years, 10 years, 15 years, 20 years. And, there are many financial market indicators like the volatility, strength, direction, so on and so forth. There are, if you look at the existing list of indicators, can be more than like 200 of them, all right? So basically, we will try to have this as our input data. And then, of course, different customer, they might have different expectations, they may have different criteria, like some you want high return, some want like low risk. So this can be part of the input data to the AI model as well. Now, once we got the data, and probably you heard about that we have many AI models, for example, random forest, k-nearest neighbor, many of them. Now, so what we want to do is we try to make use of different AI models and try to test it on the historical data. And then finally, we want to come up with some effective strategy for us to consider. Okay, so this is basically a generic framework for how we can apply AI in quantitative trading. Now, let us take a closer look on this problem first. Now, it seems like it's not as easy as one expects. You cannot just pick one AI model and then try to plug it into the data, and then you hope that you can get something useful. Okay. Now, first of all, we can look at the amount of data first. Now, okay, I give you some extreme examples so that you can see, the amount of data we are dealing with can be a lot as well. Okay. Now, for example, if we are talking about 20 years of historical data, and then we are talking about we try to get like 200 indicators. Okay, so that will be the input. So in my next slide, I will give you some calculation. Then you can estimate a little bit, how much data we are dealing with. Now, on the other hand, once you get the data ready, and probably if you know AI, you know that how many models are there. Okay, in fact, a lot. Okay, so we will try to look at different models like KNN, decision tree, logistic regression, and moreover, they have variation on each type of this model. And all you know that, okay, there won't be a single one that can fit in all situations, okay? And finally, as I mentioned, if you are talking about effective strategy, sometimes we need to mix models in order to come up with a very effective strategy to get a higher return, okay? So in other words, there's no one strategy that can fit all cases, okay? Now, if you look at the figures, okay, now let me just give you a very simple example. If we are considering like 100 stocks and 20 years of data, and then I make it simple, just take one data item per hour, then probably you can assume that we have like 24 data items per day, and then you multiply them a little bit, and then for 20 years, and then for 100 stocks, in fact, there are like 17 million records. And you can see that one data item per hour is not a lot. In fact, if you want to do a more precise investigation on the stock price, in fact, you can, have more frequent ticks, right? For example, if you're talking about 1 minute, one tick, one data item, 200 indicators, more than 100 AI model, and their variations, then you can see that each model needs to tune multiple parameters as well. If you know AI basically is the framework only. And for each AI model, we are going to tune a lot of parameters. And so that, and of course, you need to train the AI model many times, thousands of times, okay? And then finally, you might have the output of a portfolio of like, several 30 to 50 stocks, A plus B plus C, so on and so forth, okay? So you can see that the number of combination basically is very huge. And if you look, you take a closer look at this problem, we also have many variations. For example, we have different instruments, different markets we can focus on, because different markets, different instruments, or even different area, different types of stock, their behavior may not be exactly the same. So you may consider whether you are talking about China market, Hong Kong market, US market, or you're talking about stocks, futures, or even within stocks, we can classify them into categories, right? Okay. And then, of course, different markets have different patterns. And then you all know that all those indicators may not be equally effective. So in other words, you need to pick the critical indicators, or you give weighting to these indicators, or you let the AI model to tune the parameters to reflect the importance of the indicator in order to give out, effective strategy, okay? And the last question I talk about here, in fact, there's still a lot more questions, but I just highlight 3 of them so that you have some feeling, in order to use AI effectively to solve this problem might not be as straightforward as you may think, okay? Now, for example, you all know that we are not going to use 20 years data equally, okay? Because, different years, different period, there may be something happen that affect the performance of the stock, okay? So a much better way is to divide these 20 years into sensible periods for analysis, okay? But then how to divide them, okay? Of course, human can provide some guideline, but of course, we might want to try more combination in order to get a more optimal answer, okay? So you can see that all this add together, the problem becomes more complicated now. Okay, and my last question is, okay, AI, everybody know this term now, okay? So my quick question is it easy to apply AI model to capture the market performance? Of course, you know that the answer is not true, right? Otherwise, I just put in one AI model, then I will get rich, okay? Let me give you some idea or an illustration that if you try to just simply plug in a standard AI model into a set of financial data, and the performance may not be very good, okay? Now here, you can ignore the Chinese. Basically, they are talking about some of the indicators that we use in the experiment. Now, I try to pick a simple AI model, which is called K nearest neighbor. And then actually, I modify the model into something called BKNN, okay? Actually, it's a tailor-made a little bit for the financial market, for the particular, data set I'm working on. And we both try to capture the market pattern, okay? Now, if you look at our experimental result, then you can see that I will not explain it in more details because time is running short. I want to just give you some idea. The green line you can see is basically our new strategy by modifying the model to fit the financial data. And then you can see the blue line is the original one. Then you can see that actually if you know how to tune the model, I think the modified model can actually get more profit benefit, from the AI model. So basically, my conclusion is if you simply just don't understand the model and just plug the model into the data, the result may not be as good as you expect, all right? Now, there are still many technical problems that I don't have time to talk about them, but I want to give you some insights, okay? For example, if we are talking about input, if you are in the IT area, in fact, it's common for data analysis, we need to do a step which is called data cleansing. Now, this step is really, really tedious. For example, you may have missing data, and the data may not be very accurate. Then how we deal with the missing data and inaccurate data. And you all know that if we just plug the garbage in, then no matter how good your AI model is, you are going to get the garbage out, all right? And of course, the second point, I mentioned it already, not all the indicators are equally important. Some are even redundant. In other words, some indicator we can actually eliminate them. Okay, so the other question is, before we actually plug into the AI model, can we use another methodology or another AI model to identify which indicators are the critical indicators before we actually try out the other AI models, all right? Now then, on the other hand, if you are talking about the AI models, okay, and there are also 2 points that we need to consider it. For example, we probably need to tailor-make each model to best fit your investment domain, okay? Now, I will give you a simple example. For example, when we use AI models, at the basic, the simplest concept is actually we are trying to fit our current situation, our current trend, with some of the historical trend, okay? Now, so based on the data set, how we can define, okay, our current situation is similar to a particular period in the past history. So we need to define a quantitative measure. Otherwise, the AI model may not be able to work very well, okay? So we need mathematics. For example, we need to define what are the distance between one pattern and the other, okay? So we want to see whether the 2 market patterns are similar or not, okay? And of course, the second point is we need to mix the model. We actually, from my experience, we actually look at the models applied to different markets, different periods. In fact, there's no single model that can fit all situations, okay? So that's why sometimes we need to mix the model in order to get a better result. Now, here is one example I'm telling you now. If you look at these figures, now these are the price trend of 4 different periods, okay? Now, if I ask you, maybe some of the professionals, they are high quality analysis and analysts, they might be able to tell, okay, which 2 stock price pattern are more similar, okay? But on the other hand, if you want the AI model to recognize it, then you need to define a mathematical formula in order to capture, okay, among this ABCD trend, which 2 trends are more similar, all right, in order to let the AI model to learn, how to give you a best strategy, all right? So we need to use mathematics to define similarity in our domain. Now, if you know this technical stuff, then probably you know that in the standard AI model, most of the case, they will try to use a distance measure called the Euclidean measure distance. And then, but in our case, this may not be appropriate, okay, depending on what kind of data you are talking about and what kind of market you're talking about. Now, and this example, before I go on, let me just do a declaration first, okay? Actually, I also co-founded a AI quantitative trading company with my PhD graduate. So basically, I extract some of the data, some of our model here to talk about it, okay? So I'm not talking about our strategy is the best, okay? Just want to give you some example. So I have no intention to let you know that these are the best strategy, but I want to let you know that actually there are a lot of variations when you try to apply AI models into predicting the market performance. Okay, now here you can see that we try to use 20 years of data, and then we try to divide them into reasonable segment. Now, right now I divide them into year by year, but in fact, when you actually work on it, it may not be the case, because you may know that if you look at the past history, you know that, oh, maybe last year I'm doing oil, okay, last year April, you know, there's something different, okay? So maybe you need to extract that period out and then try to divide this period into some reasonable segment. And then what we do is we plug into the AI model, and then try to output some strategies. And then based on this 20 years of data, then you can see that, you know, sometimes, you know, strategy A gives you a better performance, sometimes B, sometimes C, sometimes A again, D again, A again. Okay, then as a analyst, then you should be able to, from this result, you can also try to come up with a formula to see which strategy you think may be the better, all right? And okay, let me just tell you some of the result of some of this strategy. Okay, now these are all back tests. Actually, we are using the historical data and then try to predict whether this AI strategy is good or not. We use the Hang Seng Index as the baseline. So you can see the red line is the Hang Seng Index, and then you can see obviously our strategy looks better, okay? And this is the China A stock, okay? Forget about the Chinese, but then if you look at the, I want to emphasize here is that now this experiment is a little bit old, but at that moment we're actually doing a live trading. Now, if you can see my dotted line there, before 2018, June 30th, basically a back testing. But after that, we are actually doing live trading. And then in fact, we can see that the performance of the strategy is also better than the baseline. And we also have an example on the, okay, now here is a closer look at the result. And then you can see that, I don't know whether you still remember that back in 2018, it's around July to September, there's actually a sudden drop, not really sudden, but a drop in the stock market. But then if you can see, our AI model still keep, although the return is not a lot, but then at least it's still positive. Okay, we also apply our strategy to Hong Kong stock, okay? And similarly, you can see the dotted line over there. We also do the back testing around the same period. And then after that, we have live trading. And if you look at it carefully, then here is also a closer look on the period between July 2018 to September 2018. Then you can also see that our strategy seems okay, but well, anyway, of course, I know that other company, they are using AI model. You know, some other also maybe even make better profit than us too. But anyway, now let me conclude my talk here. Okay, now I think the most critical element in the quantitative trading is whether we can come up with effective investment strategies. And I hope you also agree that AI model is a trend, or at least is an alternative that you might want to consider. But on the other hand, if you really want to do a good job in using AI for this particular trading, I think you need to consider the resources, like the expertise, computing resources, and also maybe data as well, all right? Whether how much data you can get hold of. Okay, now probably you know about it. You know, some of you are from very large company. You know, all those large investment company, right now they all also have their own AI teams for quantitative trading or even the high frequency trading. And then usually the high frequency trading team is kind of like a secret team. Okay, they never tell you any secret. Okay, similar to other algo trading team. If you look at the internet. you know, most of them, they seldom talk about, you know, their trading strategy. Okay, I think this is, you know, sometimes, of course, this is kind of like, because it's related to money earning. So that's understandable, right? Commercial secret. But anyway, now, then my next question is, then how about a small and medium-sized company? Okay, now if you look at the market, you know that the large company actually also offer services to small and medium-sized company. So one way to do it is if you are from small company, basically you can buy service from them. And my next question is it easy to build a good team? Now, let me just give you five factors here. Now, of course, if you really want a good team, some of the team member has to understand the AI model. You know, not all AI model can be applied directly into the financial data. In fact, if you heard about deep learning, you know, right now most of the deep learning, the basic, you know, principle is on neural network. But actually, there are some people pointing it out that neural network deep learning model may not be the best for financial data. And then some researchers actually propose that whether they can look at decision tree based deep learning model, whether it's you know, better fit into the financial data. Of course, if you are talking about large scale experiment, then team member need to know how to handle big data. And they need to use computer resources, experience on cloud, GPU, or some high performance computing. And of course, they also need some knowledge in financial market. Otherwise, they don't even know how to take out, how to calculate the indicators. Okay, and you know, it depends on what you want to do. It might be a big investment as well. Okay, now so the point is whether this small and medium-sized company cannot ride on this technology wave. You know, I have a different view because if you look at the community, actually for the AI model, you can start back in like 10 years, 15 years ago. There's no free framework outside that people can make use of it to build AI applications. But right now you can see we have many very good AI framework that we can make use of it to build our AI application. So I think actually even Hong Kong, you want to do this as well. We want to actually build such a framework to benefit more company, more investment company in Hong Kong, okay? So then, of course, we need funding, okay? Then I'll talk about this in my last slide. And, okay, the last point is actually Irene, Anna's also talked about this. We need another seminar to talk about this. Now, algo trading also has a lot of regulations. Okay, then how they are related, in particular for the high-frequency trading, is a very, very important issue. Then maybe I will leave it to later. Now, to conclude my talk, my last slide, Hong Kong U and Hong Kong U SCF FinTech Academy actually welcome all kinds of collaboration as long as the topic is related to R&D, related to FinTech, okay? And of course, let me do a you know, promotion here. In fact, we also have two master programs. One is the computer science program, and we have a financial computing stream. You can do it in part-time mode, full-time mode. And then on the other hand, we have a new program. It's a part-time master program, which focuses on fintech and data analytics. So I hope time's up, and then I will stop here. Thank you very much.
Thank you very much, Professor Yu. Yes, time's really short, but hope I can ask this question because there are a number of audiences interested in this. Regarding the stock price, because stock price is always unpredictable sometimes because there are many other factors affecting it, such as news.
Yes.
So what is your view on algo trading in this respect?
Okay, a very good question. Now, in fact, algo trading has its advantages. And actually, the technology cannot cover all factors, in particular, the one you talk about. Actually, we know that news can actually affect the stock price immediately. Okay. Now, so in fact, there are a lot of people doing new things on AI. They want to use AI to digest the news. And actually, it's very similar to what RegTech is doing. We need a natural language processing. We need to automatically get the news and then read it and then understand and then try to relay, which stock this news may affect, and then try to do a sentiment analysis, and then try to give you some indicator whether the stock price will rise or drop, something like this. But I agree with you. But on the other hand, even without this news factor, you can see that depending on what is the expectation you are going to set in the AI model. AI model has one good thing is it's not related to your human strategies. Okay, maybe it's more stable in that sense.
I see. So hope I can have time for one more question.
Yep, sure.
So we use AI models, and the results may be quite difficult to explain to the customers. So what is your suggestion on this?
Okay, also very good question. Actually, not all the AI models are not explainable. In fact, I think the most difficult to explain model is the deep learning model. Okay, so that's why sometimes when we try to apply AI into this kind of application, we will first skip the deep learning model and try to use the other. For example, decision tree model is also work quite easy to explain. And also the expert can look at how you build the decision tree, see whether it's reasonable or not.
Right.
Okay.
Thank you very much, Professor.
Thank you.